What's up, everybody? It's your boy LR Cohen, and welcome back to another installment of the Lone Ranger podcast. We got another great show for you today. Before we get started, just want to say thank you for everybody that's still supporting my platforms here on TikTok and Instagram. If you aren't following, you need to follow the Lone Ranger 08 on TikTok and Instagram, or on YouTube, the Lone Ranger podcast, and just look for my symbol. But to get started, just want to let everybody know that the clips on Instagram and TikTok, that's only giving you some part of the show, but it's not giving you everything. So if you want to get the full episode, go to the Lone Ranger podcast on YouTube to get all of the information that we'll be sharing in all of my installments and series. But again, thank you for joining, and let's go ahead and get started. We're going to be wrapping up our second series, which is the equity series that we've been doing these past couple of weeks, entitled It's Your Equity. So we talked about what equity was and how it's determined. We talked about different types of equity programs like the famous home equity line of credit, and we broke down the pros and cons of that. And now we're going to wrap things up with another part of equity lending, which is the equity refi or cash out refi, which is my favorite since that's my full-time product that I sell, if you will. But we're going to be going over the pros and cons of a cash out refi. And I know a lot of people kind of think that it's taboo or stupid, but after I give you some of these features and these pros and cons of the product, you may be able to see what I see in it, and which is a lot of benefit and value. But without further ado, let's go ahead and get started in the third and final installment of It's Your Equity. Thank you. So to get started, if you got your pen and paper available here, Rangers, let's define what a cash out refi is. And that's basically a mortgage refi that allows the homeowner to exchange their equity for cash. That's pretty much what it is. You have equity in your home, you can refinance your mortgage, and you can take whatever you're qualified for to take out in cash. You can apply it to do a lot of things. We can, put it straight into your bank account. We can pay off debts with it. You can do home improvements with it, as we've already discussed, and what you can do with the equity. But for a cash out refi, the general definition is simple. You're just exchanging your equity for cash in exchange for a refinance of your term and your rate and payment. Okay, so let's go over some of the features of a cash out refi. As I mentioned earlier, in a few of the other series, when it comes to doing a debt consolidation loan for that matter, it comes with a fixed payment. With a cash out refi, it's only going to be one payment. You don't have to worry about a separate payment like a HELOC or anything like that. It's one fixed payment, which is your mortgage payment, basically your top priority payment and all of your debt. It comes with discount points, which means that you can get a lower rate, lower than what you initially qualify for. And it comes with different term options. It comes with 10-year, 15, 20, 25, and 30-year terms. And you also have an option to waive your escrow in your mortgage payment. So if you have like a principal and interest, taxes, and insurance, that's called PITI, which is normally what people make as far as their mortgage payment, their principal and interest on the loan, and their homeowner's insurance and property taxes. But with a cash out refi, you have the option to just pay the principal and interest, and you can pay your escrow separate. I have a lot of people that do that. Not sure why, but it may be more convenient. I don't know. But one easy payment, you can waive the escrows if you want to, comes in different terms. And also, just like all equity programs, it can go from either to 80% or 100% of the equity or the value of the home. So whether you're doing an FHA, conventional, those are normally about 80% of the value of the home as far as the max equity you can borrow. And then with VA loans, you got 90 to 100%. So those are your features there of the cash out refi, but let's get into the pros and cons that everybody seems to be up in arms about. So one of the biggest pros that I always tell all of my borrowers that call in and looking to get equity is it comes with a fixed rate and payment. That's very important because, as you know, with our HELOC installment that we did, those adjustable payments are just around the corner whenever you're doing a HELOC. And not only could the rate adjust, but they're going to add what? Principal to the interest and just increase the payment overall over time of the life of the loan. But with a cash out refi, it comes with a fixed rate and payment. You don't have to worry about any adjustable payments or principal being added to interest only payments or anything like that. It's your principal and interest, taxes and insurance, and it's your mortgage payment. You make that payment each month. Your expenditures are covered outside of your utilities and for your gas. So that's one of the pros. Another pro is it's a convenience of one payment, like I mentioned earlier. If you're doing a debt consolidation loan, it's very, very easy to manage that debt because it rolls everything into one payment, which again is your mortgage, which is your top priority payment, which I always emphasize. Now, one of the biggest things that come with a cash out refi that I like more than HELOCs is that it's more lenient when it comes to the guidelines, which means that, you can have a lower FICO score. You can have recent revolving debts, and even active collections. I know a lot of home equity lines of credit require you to have, a 720 FICO score, sometimes even as low as maybe a 680. But with an FHA or a conventional or a VA cash out, we can go as low as 550. Well, conventional is 620, but that's still lower than a 680 or 720 with a lot of these HELOC requirements. So very, very lenient when it comes to qualification. So, if you got a 550 FICO score and you got $60,000 worth of debt, a cash out refi might be your only option here to get out of that debt. And then last but not least, there's no prepayment penalty. So a lot of people think that, if they reset their mortgage term to 30 years, then they're going to be stuck in that loan for 30 years. Realistically, nobody is going to stay in a loan 30 years. You're going to refi at least 3 times before you even move. So with no prepayment penalty, if you save some money and you want to pay it off sooner, you can do so without penalty. Or if you hit the lottery the next day, you can pay it off without any penalty. So a lot of these HELOCs come with prepayment penalties as well. So very something to be cognizant of. Now, with all pros comes what? Cons. So there are 3 major cons that come with doing a cash out refi, which pretty much everybody is scared of. So what I want to do is just explain what it is, so kind of lessen the blow and kind of understand, like, okay, this is the trade-off that comes with it. Like I've been mentioning throughout this whole series, it's a trade-off whenever you're doing any type of refi or any type of home equity line of credit. There's trade-offs. So one of the trade-offs is this, the biggest one, especially in today's market, that everybody is scared of, and that's losing your current mortgage rate and term. So a lot of these people have 2.25 interest rates, 3.5 rates. I mean, I have a 3.5 myself, so I'm a consumer as well, so I can completely understand. But in today's market, we're in the low 6s. So if you do a cash out refi, you're going to lose that rate. So a lot of people think that losing a low interest rate is going to hurt their finances, when in actuality, if it's not helping you save any money or pay off any debt, that low rate really isn't doing nothing but giving you bragging rights at a cookout, to be quite honest with you. So losing the current rate is going to be one of the, the biggest con sides, depending on the market. Like if you have a 6.5% and we're able to get you a 6.25, then this particular con doesn't apply to you. But a lot of the people that are refining have those low interest rates. So today's market is kind of scaring people off. But just want to note that depending on what you're using the equity for, like if you're using the equity to pay off high interest debts like credit cards that have 30% interest rates, or home equity lines of credit that have 11% adjustable rates, this won't be a con for you, because you're putting those those higher rates or those adjustable rates into a low fixed rate. So this con may not apply to you if you're saving money as well through the consolidation. But if you're just taking cash out to do home improvements, then you can make an argument with this con. The next con here is higher settlement fees. This is something that you have to make peace with, especially if you have a high mortgage balance. So for those who have $400,000, $500,000, $600,000 mortgages, but they got $60,000, $70,000, $80,000, $90,000 worth of credit cards, a $700,000 loan is going to come with $700,000 fees. So depending on the program, the fees may be pretty costly. To give you an example, if it's a VA loan and the veteran doesn't have any VA disability, then it's 3.5% of the loan amount for the VA funding fee, which is mandatory. So if you got a $500,000 loan, you're looking at about 15 grand right there in fees alone for the VA. That's not including any discount points, title and processing fees, and of course escrows. So it can be kind of costly if you are, if you have a high mortgage balance, or if you're paying off a lot of debt. I had a client this week, I was paying off $150,000 worth of debt, and they were not too happy about their closing costs being over $20,000. But I explained to them what made the loan benefit, what the benefit of the loan here is. And this is a note that I want you guys to take, when you're considering the settlement fees here, whenever you're talking to the borrower, or if you're a consumer and you're doing a refi, and that is this: the rule of 3. And that is, If your savings does not pay you back within 3 years, the cost to do the loan within 3 years, then it may not be a beneficial loan. So to give you an example, if you have someone who saved $100 a month, okay, that's $1,200 a year. Take that $1,200 and multiply it by 3. That's $3,600. If your closing cost is more than $3,600, then it may not be a beneficial loan. But if the closing costs are $1,000 or $2,000 and you save $3,600 over the 3 years, then it's considered a beneficial loan because your payback period is below 3 years. And it's normally a rule that we use in the EARL loan programs, the rate reduction programs that everybody got in 2020. If the savings reduction didn't pay back the loan in 3 years, then it wasn't considered beneficial. So that's one thing that you can use. And then the very last con side of Cash Out Refi is that it's a closed-ended loan, which means that you get this money in a lump sum. So if you want $50,000, they're going to give you $50,000 in cash. Unlike the home equity line of credit, where you get approved for $50,000 and you can use up to $50,000 like a credit card. Doesn't work like that with a cash out. It's closed-ended. So if you want $50,000, you're getting $50,000. Now, one thing I tell people is if you find out that you don't need that much, you can go ahead and throw it back into the mortgage if you want to. So that's always an option if you take out more than what you need. But essentially with a cash out refi, you want to make sure that if you're doing any home improvements, make sure you got your estimates already. And if you're doing any credit card payoffs, make sure you got the most recent statements to make sure that you're paying off the right amount and you're not overpaying and having to wait for any credits, or maybe you don't have enough cash for the home improvements because you underestimated. So those are the little things that you need to do with a cash out. Just make sure all your T's are dotted and your T's are crossed and your I's are dotted to make sure that everything is working for you. But that is pretty much it for the cash out refi. Examples of pros and cons and the features. So the biggest takeaways is that it comes with a fixed payment. It's a lump sum style type of loan. You get the cash that you asked for in a lump sum. Just like HELOCs, you can go up to between 80 and 100% of the value of the home. And it comes with a fixed rate and payment, which is the biggest takeaway here versus the adjustables that come with a HELOC. So that is it. That wraps up our series, It's Your Equity. And I hope you enjoyed it. Yeah, appreciate it. Thank you. So till next time, and our next series, we're going to be covering the features of debt management plans. A lot of people don't understand the differences between certain debt management plans, and it can kind of set them up for failure if they're not careful. So we're going to tackle that in our next episode. But until then, we definitely appreciate you. It's the Lone Ranger signing out. Peace, y'all.